A few years ago, passive mutual funds, that is index funds, were not that popular in India. Although passive funds are highly popular in developed countries like the USA. In fact, passive funds in USA accounts for more than 50% of total AUM, that is asset under management. However, passive funds are now also gaining traction in India because investors have now understood that in the long term, it is difficult for active mutual funds to beat the index, especially in the large cap category that includes the top 100 stocks of India in terms of free float market cap. Hence, investors are now opting for low cost index funds in large cap category that helps them invest in top 100 companies of India at a very low cost as compared to the active mutual funds that charge higher expense ratio. Just to give you an idea, between March 2016 and March 2021, the AUM of passive funds in India rose from 22,409 crore to rupees 3,10,330 crore, reflecting a CAGR growth of 69%. In 2018, passive funds were just 0.8% of total AUM in India, but in 2021, passive funds accounted for around 10% of total AUM. Although it is very low as compared to the passive fund contribution in the USA. But this trend would continue to grow and passive funds are expected to contribute around 37% of total AUM in India by 2025. So clearly, the future of mutual fund investment in India is passive funds. Hey friends, my name is Sahil and this is my Personal Finance Academy. Now we have already discussed about Nifty 50 index and various index funds in this category in one of my previous video. But in this video, I want to discuss about Nifty Next 50 category that include the next blue chip stocks. While you should certainly have a Nifty 50 based index fund in your portfolio, the question is, what about the Nifty Next 50 stocks that have the potential to grow and eventually move to Nifty 50 category? For example, in 2021, Tata Consumer Products moved from Nifty Next 50 to Nifty 50 category. Before that, in 2020, 4 stocks grew big enough to move from Nifty Next 50 to Nifty 50, including Shree Cement, HDFC Life, Divis Lab, and SBI Life. Likewise, every year you will see some stocks growing big enough to become the next blue chip and move to Nifty 50 category. In fact, in last 19 years since 2002, a total of 75 stocks were added to Nifty 50 index, and out of that, 51 stocks moved from Nifty Next 50 to Nifty 50 category. Some of the examples are Titan, Bajaj Finance, Eicher Motor, and so on. So these stocks were once part of Nifty Next 50. During this growth journey, they created a lot of wealth for their investors and rewarded them with great return. In case you are thinking Nifty 50 has only 50 stocks, then how come 75 stocks were added? Then the reason is because all these indices are dynamic, where the stocks get included or excluded based on their performance. Now let's first try to understand the difference between Nifty 50 and Nifty Next 50 index. In simple language, Nifty 50 index represents the top 50 companies of India in terms of free float market cap, whereas Nifty Next 50 index represents the next top 50 companies ranking from 51 to 100 in terms of free float market cap. Please note that this index is dynamic in nature and gets updated on a frequent basis. If you look at the top 10 stocks in each index and their weightage, top stock in Nifty 50 is Reliance Industries Limited with 10.77% weightage. It is followed with Infosys with 9.23% weightage, then HDFC Bank with 8.54% weightage. Then it includes ICICI Bank, HDFC Limited, Kotak Mahindra Bank, L&T, HUL, and ITC. Top stock in Nifty Next 50 include Avenue Supermart with 4.23% weightage. It is followed with Apollo Hospital with 4.06% weightage, then Adani Enterprise with 3.78% weightage. Then it includes Vedanta, then Info Edge, then Pidilite, then Godrej Consumer Product, Adani Transmission, Adani Greens, and ICICI Lombard General Insurance. If you observe, Nifty 50 is more concentrated towards the top few companies. In fact, the top 5 companies in Nifty 50 contributes around 41% in the index, whereas top 5 companies in Nifty Next 50 contributes around 18%. The top 10 stocks in Nifty 50 contributes 58%, whereas Next 50 contributes around 33%. Then top 20 stocks in Nifty 50 contributes around 77%, whereas Nifty Next 50 contributes around 56%. And bottom 10 stocks in Nifty 50 contributes only around 5%, whereas Nifty Next 50 bottom 10 contributes around 11%. This suggests that Nifty 50 has higher concentration risk and Nifty Next 50 is more diversified than Nifty 50. Now let us look at the sectoral composition of both the index. In Nifty 50, the top sector is financial services with 35.6% weightage. It is followed with IT sector with 19.08% weightage, then oil and gas with 12.31% weightage. Then it includes consumer goods, automobile, pharma and so on. Then top sector in Nifty Next 50 is again financial services with 19.91% weightage. It is followed with consumer goods with 16.75% weightage and then metals with 11.06% weightage. Then it includes consumer services, pharma, power and so on. Clearly Nifty 50 has higher concentration towards the financial sector, that is a weightage of around 36%. And top 3 sectors contribute around 67% in Nifty 50, whereas it is around 58% in Nifty Next 50. This suggests that Nifty Next 50 offers better diversification at both sectoral level and individual stock level. Now let us look at the return comparison of both the index. If we compare the return between Nifty 50 and Nifty Next 50 over the years, you can see that in 2004, Nifty Next 50 outperformed Nifty 50 returns. Again in 2005, Nifty Next 50 outperformed Nifty 50 returns. Then over the next 4 years, Nifty 50 outperformed Nifty Next 50. And then again in 2010, Nifty Next 50 outperformed Nifty 50. If you look at period between 2014 and 2018, Nifty Next 50 consistently outperformed Nifty 50 returns. Just to summarize, out of last 18 financial years since 2004, Nifty Next 50 has outperformed Nifty 50 index 10 times as compared to Nifty 50 that outperformed Nifty Next 50 index 8 times. Clearly, it makes sense to have exposure in both Nifty 50 index fund and Nifty Next 50 index fund. Now the question is, what options do you have to invest in Nifty Next 50 index? But before you shortlist any fund, remember that you need to look at the expense ratio and tracking error of the index fund. Lower the expense ratio, better it is. Likewise, lower the tracking error, better it is. I hope you understand what is tracking error. It is basically the difference between index return versus index fund return that replicates the index. Now some of the options for investment in Nifty Next 50 include UTI Nifty Next 50 index fund that has latest expense ratio of 0.33%. Next is SBI Nifty Next 50 index fund with expense ratio of 0.34%. Then you have ICICI Nifty Next 50 with expense ratio of 0.3% and SDFC Nifty Next 50 with expense ratio of 0.3%. But this space is getting disrupted with new age fintech players. For example, Navi Mutual Fund has launched its NFO of Nifty Next 50 index fund starting 1st January 2022 with an expense ratio of 0.12%. So that would be the lowest expense ratio in Nifty Next 50 category. This NFO would close on 15 January 2022. In fact, a few months ago, Navi also launched an index fund in Nifty 50 category with lowest expense ratio of 0.06%. Now I think that in the future, index fund with the lowest expense ratio and lowest tracking error would lead the category with highest AUM. Here I want to discuss a very interesting point. If Nifty 50 and Nifty Next 50 include the top 100 companies, then rather than investing individually in Nifty 50 and Nifty Next 50 index, can you invest in Nifty 100 index? Well, of course you can, but there is a catch. As I mentioned before, the weightage of each stock in the index fund is based on their free float market cap. Now, if you opt for Nifty 100 index fund, then almost around 85% of your money would be invested in stocks from Nifty 50 index because the top 50 stocks of Nifty have almost 85% weightage in top 100 stocks of Nifty 100 due to their high free float market cap, and only around 15% would go into Nifty Next 50 index. So from diversification perspective, your fund would still not be diversified and would be highly skewed towards Nifty 50 stock, and hence it is better to break your investment equally in Nifty 50 and Nifty Next 50, where out of rupees 100, rupees 50 can be invested in Nifty 50 index fund and rupees 50 can be invested in Nifty Next 50 index fund. This would result in reducing your concentration risk by providing better diversification. So in this video, we discussed the difference between Nifty 50 and Nifty Next 50 index. Nifty Next 50 include companies that have the potential to become the next blue chip stocks. Moreover, Nifty Next 50 is more diversified at both sectoral level and individual stock level. This results in lower concentration risk and better risk adjusted returns. And historically, Nifty Next 50 has beaten Nifty 50 in returns 10 times out of last 18 times. Hence, it makes sense to have equal allocation in both indices. And remember that Nifty 100 index fund doesn't mean equal weightage to Nifty 50 and Nifty Next 50. It is because Nifty 50 stocks would have almost around 85% weightage in Nifty 100 index due to their high free float market cap. So if you want equal allocation in both Nifty 50 and Nifty Next 50 index, then you need to invest individually in both index rather than Nifty 100. And while selecting the index fund in each category, ensure that you choose the mutual fund with lowest expense ratio and lowest tracking error. We have already discussed the index fund in Nifty Next 50 category. In case you want to explore the NFO of Navi Nifty Next 50 index fund, I have provided the link in the description. I hope you will find this video useful. Now tell me in the comments, do you invest in active mutual funds or passive mutual funds? And if you invest in index fund, then how much percent have you allocated in Nifty 50 and Nifty Next 50? I'll see you in the next video. Till then, take care. Mutual fund investments are subject to market risk. Read all scheme related documents carefully.